Hello again. I'm Sue Lloyd, Vice Chair of the ISSV, and we're back with you to do a deep dive into Chapter 3 of the Materiality Guide. Picking up from where we finished in the last webcast, now that the entity has identified the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects, we'll take a look at how it might identify and disclose material information about those sustainability-related risks and opportunities. This is webcast 4 of our 5-part series. We've already gone through the introduction and overview of the Materiality Guide in the first webcast, the definition of material information, and an explainer of sustainability-related risks and opportunities. In this webcast, we'll build on chapters 1 and 2 and explain how to identify and disclose material information about those risks and opportunities. I recommend that you watch these webcasts in the order shown on this slide. I'm going to hand over to Dave, who's going to kick off this portion of the discussion.
Thanks, Sue. Great to kick us off on the deep dive on Chapter 3. I'm David Balderston, ISSB Technical Director, and I'm joined by Dionara DeMarco, ISSB Technical Fellow, who leads our implementation work. And we will take you through this chapter together. The Materiality Guide sets out an example of a 4-step process, as shown on this slide, that an entity might use to identify and disclose material information. This process is designed as a guide to help an entity efficiently and effectively apply judgment to make this assessment. For those familiar with the IASB's document, so for a document from our sister body, the IFRS Practice Statement 2, Making Materiality Judgments, this process should be recognisable as it is very similar. So again, this is an example of the ISSB using existing materials from our sister body, the IASB, in this case the materials that they publish to support the application of the aligned materiality definition. For those that are less familiar, it's a good example of a process an entity could follow. To be really clear, an entity is not required to follow the process. This is an example of a process an entity could follow, and is a helpful way of explaining key requirements in the standard related to identifying material information. Let's walk through the 4-step process at a high level, and then on the next slides, we'll discuss each step in more detail. So on the left, you can see the 4 steps, and then on the right here, you see the output from each step, and this output is what links to the next step. So to start us off in step 1, an entity identifies information about sustainability-related risks and opportunities that has the potential to be material. So the output of this is a set of potentially material information. You then assess that potentially material information in step 2 to determine whether or not that information is material. Your output here is a preliminary set of material information. You then take that preliminary set of material information in step 3 and organise it, which results in a draft set of sustainability-related financial disclosures. And finally, that draft is reviewed, resulting in your final sustainability-related financial disclosures. So then let's next take a look at each of those steps. So step 1. As a starting point to identifying the information about sustainability-related risks and opportunities that has the potential to be material, entities apply the requirements in the ISSB standards, including the provisions related to sources of the guidance. In addition to the particular disclosures set out in the ISSB standard, entities are required to disclose additional information when that information is necessary to enable primary users to understand the effects of sustainability-related risks and opportunities on the entity's prospects, even if an ISSB standard does not specifically require the disclosure of that particular information. And we're going to say more about that requirement in step 3, so hold that thought for now. The flowchart to the right of this slide reflects this. That is the identification of applicable disclosure requirements about the sustainability-related risks and opportunities identified by the entity. So this is what information to provide once you have identified which sustainability-related risks and opportunities to provide information about. Let's walk through the flowchart. As we noted in our webcast about identifying sustainability-related risks and opportunities, this is very similar to the sources of guidance requirements used in identifying sustainability-related risks and opportunities, but with a couple of distinct points that are really important that I'll call out. So as we walk through the diagram here, firstly, entities must apply IFRS 1 in all cases. Next, IFRS S1 requires that entities apply the ISSB standard that specifically apply to the identified sustainability-related risk or opportunity. So, for example, if an entity identifies a climate-related risk or opportunity that could reasonably be expected to affect its prospects, the entity will apply IFRS S2, the climate standard, alongside IFRS 1 as the starting point to work out what information about climate-related risks and opportunities to disclose. This is the right-hand side of this diagram here. In the absence of an ISSB standard that applies to a specific sustainability-related risk or opportunity that an entity has identified, an entity applies judgment to identify information to disclose about that risk or opportunity that is relevant to the decision-making of primary users and faithfully represents that sustainability-related risk or opportunity. In making this judgment, the entity applies the requirements about using alternative sources of guidance. So this is the middle grey box of this diagram here. So following this through is depicted in the grey box of the diagram. So again, as with the identification of risks and opportunities, IFRS S1 requires an entity to refer and consider the applicability of SASB standards, which are industry specific. IFRS S1 also sets out other sources of guidance that an entity may refer to and consider the applicability of. This is the middle white box on the left side of the diagram. What I do want to focus on is what is different in the sources of guidance that can be used to identify what to provide information about, so in the identification of risks and opportunities, and what an entity can consider when determining what information to disclose about those risks and opportunities. So in the case of identifying what information to disclose, entities may also refer and consider the applicability of requirements in GRI standards and IFRS subject to specific conditions. That is, IFRS 1 providing additional sources of guidance an entity may refer to and consider in addition to considering CDSB, materials of other investor-focused standard setters, and industry practice or regional practice. Specifically, an entity is able to use IFRS and GRI standards to identify potential disclosures about the sustainability risks and opportunities it has identified if these sources enable the entity to meet the objective of IFRS 1 to disclose information about sustainability-related risks and opportunities that is useful to primary users and do not conflict with the ISSB standards. So the key point here being the sources of guidance used to identify sustainability risks and opportunities and to identify potential disclosures are very similar, but a key distinction is the reference to GRI and IFRS, which is only used when identifying disclosures and can only be used subject to specific conditions being satisfied. The output then of step 1 is that we have a set of potentially material information. In step 2, an entity assesses whether the potentially material information identified in step 1, following the requirements of the standard and providing additional information, is in fact material. This assessment requires the entity to apply judgment, taking into consideration its facts and circumstances. On the slide here, we highlight some things an entity might consider, including first, an entity is required to consider both quantitative and qualitative factors. An entity could identify information as material based on one or more quantitative or qualitative factors. The materiality guide provides a number of considerations building from the IASB's practice statement, but providing these considerations in the context of ISSB standards. For example, highlighting there is no hierarchy, neither quantitative factors nor qualitative factors are more important than the other. Further, in relation to qualitative factors, the need to consider the effects of qualitative factors such as the industry the entity operates in and the expectations of primary users. In addition, entities may need to assess whether the information about possible future events with uncertain outcomes is material. And in those cases, the entity must consider the range of possible outcomes and the likelihood of the possible outcomes within that range. For example, an entity would consider both the probability of an event occurring and the magnitude of the potential effects. Lastly, entities are required to consider whether there are changes in circumstances and assumptions at each reporting date. For example, the entity's circumstances might change because it has expanded its operations into new jurisdictions, and therefore its materiality judgments will take into account its operations in those new jurisdictions. The output of step 2 is a preliminary set of material information, and Dianora will take us through the next steps related to this preliminary set of material information.
Sure, thanks, Dave. And so now we're in step 3, and this is where the entity takes that preliminary set of material information from step 2 and organizes this information in the draft sustainability-related financial disclosures in a way that communicates the information clearly and concisely to primary users. This requires judgment, particularly around aggregating and disaggregating information, whether any information is obscured, and whether the information disclosed is in fact material. This chapter explains some of the requirements associated with these areas and includes some examples, such as including a list of examples of when there might be different circumstances that could result in material information being obscured. And the output of step 3 is a draft of your sustainability-related financial disclosures. But I want to come back to this point on disclosing material information, which is on the right-hand side of the slide. This is about the requirement that information, even if it's not explicitly specified by an ISSB standard, is required to be disclosed if an entity concludes that particular information is necessary to enable primary users to understand the effects of a sustainability-related risk or opportunity on the entity's prospects. And I think the example on the next slide illustrates this point pretty clearly. So let's take a look, maybe starting with the box on the right-hand side of the slide. So as Dave explained in Chapter 1, which was our second webcast, the objective of IFRS S1 is to disclose information about sustainability-related risks and opportunities that is useful to primary users' decision-makings. Then, as I explained in our third webcast on Chapter 2, an entity's dependencies and impacts on resources and relationships might give rise to sustainability-related risks and opportunities that could reasonably be expected to affect the entity's prospects. So this example brings that understanding together in explaining the additional information requirement. So that is explaining that information about those dependencies and impacts might represent material information that enables primary users to understand the effects of sustainability-related risks and opportunities on the entity's prospects. So while not explicitly required by ISSB standards, in such circumstances, ISSB standards would require this information to be disclosed. This brings us to a really important interoperability call-out that explains that in ESRS standards, impact materiality assessments consider how an entity impacts people or the environment. GRI standards consider how an entity impacts the economy, environment, and people, including impacts on their human rights. This is sometimes referred to as an inside-out perspective, and in very plain English, this is because of its focus on these impacts. However, describing ISSB standards as outside in, so the inverse of inside out, is an incomplete and therefore incorrect description. As we've just explained, the effect of an entity's activities on resources and relationships, including on people and the environment, might give rise to sustainability-related risks and opportunities that could reasonably be expected to affect the entity's prospects, and thus are relevant when applying ISSB standards. And in such cases, information about these impacts and dependencies, if omitted, misstated, or obscured, could reasonably be expected to influence decisions of primary users that they make on the basis of the sustainability-related financial disclosures, then it's required to be disclosed. Now, this wraps up step 3, and the output of step 3, now we have our draft sustainability-related financial disclosures. So moving on to step 4. So in step 4, the entity takes the output from step 3, and it just takes a step back and it considers the sustainability-related financial disclosures as a whole. For example, an entity might step back and consider whether it has complied with the requirements related to connected information and ask itself whether primary users will understand connections between disclosures in its sustainability-related financial disclosures and other disclosures that are part of its general purpose financial reports. It also checks that information determined to be immaterial is still immaterial when considered together with other information in the context of its sustainability-related financial disclosures, and whether looking at the package of disclosures, particular information is indeed material. Some of these example considerations are set out on the right side of the slide, and there are more examples in the materiality guide. This review could lead to an entity to reconsider its assessment in step 2, assessing potential material information, resulting in more or less information being provided in the sustainability-related financial disclosures. With that, the output of this last step is the final sustainability-related financial disclosures. And that brings us to the end of this webcast.